Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these weekly live streams. We try to go live every Monday at 9 a.m. Eastern, just before the market opens. Show you, what to watch for this week, some of the stocks I'm watching, as well as all those stock market news, the trends and strategies that you need to know about. Want to get started real quick this week because obviously, the market just it looks like it's going to enter a bear market for the Nasdaq anyway. That tech-heavy Nasdaq index down 20% now from its peak last year. The S&P 500, so the broader market index, not quite there yet. I think that one's down maybe 18 or 19%, pretty close though. So definitely a big sell-off over the last couple of months, obviously on the Ukraine conflict, on the invasion, as well as what was leading up to the Fed's rate hike on the 16th of this month, and a lot of other things that we need to talk about. What we know about the war, about the invasion, how we can use that in our investing strategy, and really not get too panicky and sell out of some really great stocks that you want to hold long term. So we're going to talk about kind of a longer term investing strategy for that, as well as some of the other the news that I'm watching for this week and for the rest of the year. I do, like I said, it is painful, but you have to put this into perspective. We are probably just getting the reset in the stock market, in valuations that could have taken, half the year to get. Stocks started coming down in November on those rate hike fears, on the build up to the Fed rate hike cycle. And this really the Ukraine invasion really just accelerated the sell-off that we saw before. Stock market valuations are now looking pretty attractive though. Okay, the S&P 500 forward PE ratio. Okay, so that's the price of the S&P 500, all the stocks, the largest 500 stocks based in the United States. The price of those divided by the earnings that analysts are expecting them to report over the next year. That is now down to the 5-year average at 18.8 times on that price to earnings ratio. Okay, so for perspective, that was up as high as 23 times on a forward price to earnings ratio. It was much higher. It was about 30 times on that regular trailing price to earnings ratio last year. But it was up about 23 times price to earnings ratio last year at the peak. It's now back down to the 5-year average of 18.8 times. Okay. 10-year average a little bit lower, right around 16.7 times. So stocks are still, even after the sell-off, are still a little bit more expensive than they have been on average over the last 10 years, but they're right around that 5-year average. So obviously much lower. It's about a 10-15% discount from where it was back in November. Some of the sectors, and we'll look at some of the valuations on some of the sectors in a little bit, but some of the sectors are actually cheaper than they have been over the past 5 years. So you've got materials, so stocks in the materials sector. That's going to be a lot of chemicals, your miners, things, companies that are producing those materials, right? Those are now at a 15% discount from from where they've been over the last 5 years on average. Okay, others, healthcare is at a 5% discount. Okay, a lot of healthcare stocks, especially the drug makers, have come down since last year. The facility stocks have never quite rebounded from the pandemic. A lot of the healthcare facilities, they had to push off a lot of their elective procedures, a lot of those other procedures that are actually higher margin, higher profitability. They had to push those off to triage to care for the COVID patients, right? We were expecting those services and procedures to come back, boost the bottom line for a lot of those facilities and healthcare stocks this year. That hasn't happened yet because the rest of the market has come down and brought healthcare down with it. The industrials also down 3%, from its 5-year average PE ratio. So there are some pockets of strength here, or pockets of good valuation here coming up through the market, and so we want to step back, look at the market right now, and see really how do we invest in that. Okay, so we're going to talk about a strategy for that. I want to get started. I do see a lot of great people, great members of the Bowtie Nation there in the comments in the chat. I appreciate that. I do want to invite you to actually a free webinar going on today. So you have to sign up for this webinar today. It's on Interactive Brokers. You don't need an account. You don't need to sign up for Interactive Brokers or anything. Basically, you just go here, you click through the link I left in the chat or in the description below. You go here to Interactive Brokers, you click on Education in the menus, and go to Webinars. Now, this webinar, why I bring this up today is because it is Protect Your Portfolio with Put Options. This is going to show you, this webinar is going to show you how to protect your portfolio using put options. Really, that idea, that theme of portfolio insurance, really important right now. You go through there, so you click on that link I left in the chat or in the description below. Click on there, click register. You can register. It's absolutely free to register, absolutely free to sign up there. They're not going to ask you any personal information or to sign up for Interactive Brokers, anything like that. Totally free to sign up. So look for that. Obviously, you can watch the webinar as a recording later, but it's going to be live today. Sign up for that. And even if you're not interested in that portfolio insurance idea or being able to protect your portfolio with options, look at some of these other webinars. They're all free, absolutely free. No account needed on Interactive Brokers. Just look through some of these and sign up for those. So I'll leave that in the chat below. Make sure you sign up. Take advantage of those free webinars. I want to get started because it does look like obviously the market is going to open lower. We've got about 20 minutes left till the open. Nasdaq futures are down 0.6%, well off the lows though. At the lows, futures were down about 1.5%. So the market is looking like it wants to come back. Crude oil bounced to $130 overnight in the after trading market or in the futures market. Crazy increase in crude oil, and something we're going to talk about today when we talk about that strategy of how to invest going forward. But I do want you to think of this as as kind of an exercise, right? There is no pain, there is no gain without the pain, right? Is that what they say? And it feels like a lot like that. Like I said, we got that reset that we really did need in valuations. It's tragic that it had to come at the expense of a war, and a lot of people are suffering. But we are getting that reset. Stock valuations, like I said, down to 18.8 times on that price to earnings ratio for the S&P 500. That's right around the 5-year average, which, if you've been watching stocks for the last 5 or even longer, 5 years or even longer, stocks have been incredibly expensive, right? And it's, especially for a value investor like myself, it's very hard to justify buying new stocks with stocks so expensive, especially some of those growth stocks. Some of the growth stocks that hit 30 and 40 times on a price to sales ratio last year. You just can't work with anything like that. So obviously those have come down. The entire market, the broader market, has come down, and we're seeing some really attractive valuations right now. Now, I do believe that the Ukraine conflict, the war, is going to get worse before it gets better. Putin wants, and the Russian government wants to send a message that they won't allow a lot of those frontier countries with Russia to become closer to the West and shut off its access. So they want to send a message. They want to demilitarize Ukraine, but they're having a problem with it because the Ukrainians, they are fighting, man. They are lining up to fight, to fight for their country. So that's really becoming kind of a quagmire, kind of another Afghanistan for Russia. So if you remember, Russia tried to do the same thing back in the 80s in Afghanistan and was just bogged down for nearly a decade, more than a decade, really, on fighting the insurgency there. But we're going to talk about that. We're going to talk about what we know about Russia's strategy in Ukraine, what it wants, and when and if it gets there, and kind of how that's going to affect the market over the next probably 2 or 3 months at least. It's not likely to drag on much more beyond the summer, I think. Russia does not need these economic sanctions. Believe me, the economy still was not in great shape before the sanctions. The sanctions have cut it off from $630 billion in its foreign exchange reserves, as well as sanctions against the banks and against a lot of its companies. So it's causing real economic pain and hardship in Russia. And obviously, I think moving the country closer towards some kind of a negotiated settlement and that kind of thing. So we'll talk about that as well. Last week, we can look at how the markets are going to open. this week and kind of look at where they were last week, all three major indexes closed sharply lower last week. Obviously, the Nasdaq down almost 2.8%, and the S&P 500 down 1.3%. So the Nasdaq is now down below 20% from its peak. The S&P is getting there real close, so we'll have to check that out. So again, in a bear market territory, 20% down from the peak prices last year. The oil is up 25% just in the last week. And again, it hit $130 a barrel overnight here. It's now up about just 2.5% to $118 a barrel. We're at the point where the oil is going to start causing real economic pain globally. In fact, especially here in the United States, in Europe, and is actually starting to bring economists' expectations for global GDP and for U.S. economic growth down. A survey of economists said, that I read this morning, brought U.S. GDP growth down to about 3.2% this year, down from about 3.7% earlier. It brought the European GDP or economic growth down to about 3.4, 3.5%. So those higher oil prices are starting to weigh on economic growth, and so we'll start seeing that we're already starting to see some pretty drastic measures by the government try to ease that pain. Gold rallied 4.5%. After an earlier sell-off last week. It's now up just slightly this morning, up to $1,980 an ounce, really close to that all-time record set in I think it was 2019, 2020 that we hit $2,000 an ounce in gold. So it's up there. As I've been saying, over the past couple of weeks. I like the gold miners here. They are cash flow machines, right? A lot of the gold miners have an all-in sustaining cost, which is basically the cost of their production plus all their their maintenance capital expenditures, things like that. Everything they need to keep on producing that gold indefinitely, basically. Their all-in sustaining costs are right around $1,300 a barrel for $1,200 or $1,300 an ounce for most gold miners, for a lot of gold miners. So $1,900, even $1,800 an ounce for gold is a cash flow machine for these gold miners. Gold itself, buying the physical gold commodities, it's not necessarily a win situation there, because you got to look at the range that we've been in over the last couple of years. Gold was stuck in a range from $1,750 to around $1,850 an ounce. It took a war, it took the threat of a world war to push it above that range, above $1,850 an ounce. So, obviously, I think even despite the inflation that we've seen, all that kind of stuff, if gold isn't able to just surge higher in that, then I think it just really speaks to the overvalued nature of gold. So, maybe go to the gold miners, buy shares of those, but I would avoid the physical gold itself. Bitcoin jumped initially last week on as a safe haven status and purchases by a lot of Ukrainians, a lot of regular Russians trying to protect their money. The Russian ruble has just collapsed down something like 35-45% against the dollar over the past month. So a lot of people trying to protect the value of their wealth in Bitcoin and in some of those other cryptocurrencies. It did come down last week, closed about flat for the week. And we'll check on Bitcoin there. One thing I do want to talk about on Bitcoin is the idea, the belief by a lot of people that Bitcoin or cryptocurrencies are going to allow the Russian government or the rich, the oligarchs or the banks in Russia to avoid sanctions, and it's just not real, folks. It's false. If you look, and we'll talk more about this later, but if you just look at the trading volume and the liquidity and the scale of cryptocurrency right now. Cryptocurrency market, the entire cryptocurrency market is only $2 billion. Okay, if you're talking about Russia, the government being cut off from its $630 billion in foreign exchange reserves, the banks, being sanctioned and needing to move, some billions of dollars, tens of billions of dollars around, to avoid those sanctions. It's just not possible with cryptocurrency, especially even with Bitcoin, which is close to a $1 trillion net worth. Excuse me. The entire cryptocurrency market is $2 trillion. Bitcoin is about $1 trillion, but the daily volume is very much lower. The daily volume on Bitcoin is only about $18 billion. So if that were to, if the Russian government, the banks, or some of the oligarchs were trying to avoid sanctions using Bitcoin, immediately see it in the trading volume for any particular day. It would be immediately something you would see and be able to track through that Bitcoin. So we're going to move on, though. We'll come back to that in a little bit. I do want to look at some of the sectors, what the sectors did last week. Kind of get an idea of which are performing well, which ones we can kind of look at. We're going to use the select sector spiders here, sectorspider.com. It's one of my favorite resources. It shows you really where the sectors of the economy, all the stocks in those sectors are doing, and kind of gives you an idea of what to do around that. If we look at last week, 5 of the 11 sectors actually closed in the green last week, which was kind of surprising. As bad as a week as it was, we actually did have 5 sectors move higher. And what was really interesting here, I think the bigger surprise here was the difference in the performing sectors versus the ones that fell. Okay, because so obviously energy 9.2% up last week. The stocks in the S&P 500 energy index just amazing there. But taking that out, because obviously that was a little bit of an outlier. But looking at some of these others, healthcare up 1.2%, industrials up 1.3%. Real estate up 1.8%, utilities up almost 5% last week. And what was even more surprising here was the difference between those, up 1 or 2% on the winners, and down 1.5–2% on the losers. So we're seeing a real gap, a real difference between what the market is looking at as far as who could be winning in this environment, and the relative losers. And I think what you see here, if you look at this, you see the difference between sectors where most of the stocks, most of the companies in the S&P 500 benefit from domestic sales, domestic revenue versus international sales and revenue. Okay, so obviously, if you've got a lot of healthcare companies, which are going to be facilities, you've got a lot of international drug makers and medical devices and things like that as well. But you've got a lot of facilities that are very much U.S. domestic companies. You've got obviously utilities. Utilities get like 95% of their revenue domestically from the U.S. Very little of the revenue in the S&P 500 utilities sector comes from internationally. So obviously, as long as U.S. economic growth keeps up and that kind of thing, then utilities should continue to do well. Like real estate as well. Obviously real estate, those real estate companies that own property in the United States, the vast majority, like 90% of their revenue comes from the U.S. So you see things like that. You see, industrial. Some of these were just very attractive valuations anyway. Like we said, the healthcare sector, the industrial sector, material sector, stocks in those 3 sectors are now trading below their 5-year price to earnings average, right? So they are attractive valuations anyway. I think that's what's part of what is supporting those stocks, besides that domestic revenue theme that we're seeing. Obviously, the losers, much more internationally focused. Technology gets something like 45–50% of its revenue. The stocks in the technology sector, 45–50% of their revenue internationally. You've got also communication services, which is your telecoms, your internet companies, things like that. Staples was kind of surprising. Consumer staples down 0.05%, basically flat. These are usually the safe haven stocks, the stocks that you run to if cash flow and earnings for other companies are in jeopardy. Because those consumer staples, those are the things you need to buy. Those are your toilet paper and your food and things like that. But that was down last week. Financials down 4.8% last week. A lot of that was on the drop in interest rates. Okay, interest rates have fallen down to about 1.72% on the Treasury. They were higher than 2%. And obviously, financials, a lot of those banks, they make their money on those longer term rates, right? So as rates rise, banks and other financial companies make more money. So, as those rates come down, then that's bad news for the profitability on the banks. I do like the financials for the rest of the year. Obviously, we'll talk about the idea of how long this Ukraine conflict can last, what it means for the market, and obviously once we move on from there, rates are going to shoot back higher. Okay, rates are heading higher. We've got 7% inflation. The Fed is just starting its rate hiking cycle this month here on the 16th. And those banks are going to start making money again. So I think that's one thing you want to watch. What else? I want to look at. Okay, so what I'm watching this week. Obviously, Russia is going to be the factor in the markets this week, and probably until it's resolved. Okay, until we get to some kind of negotiated settlement. And what I want to do here is kind of step back and think of, okay, what do we know about this? What do we know about the invasion of Ukraine? What do we know about the markets itself, and kind of how to draw from that? Because that kind of thing, you can never really you can't really time it. Okay, nobody can time the market, especially around those geopolitical kind of events. But we can kind of say, okay, what do we know about it to give us an idea of whether it's going to be very long and protracted, maybe it'll be a little bit shorter, and give us some ideas of how to invest around that. Okay. Like we've been talking about over the last couple of weeks, we know Russia. The Russian government does not want Ukraine. Basically, its stated terms is to demilitarize Ukraine, Putin's come out with the denazification of Ukraine, which is really just bullshit because the president of Ukraine is Jewish himself. It's just a pretext to go to war. It's something that really speaks to the Russian population. Really, that denazification. You got to understand, folks. Russia lost something like 10 million people in World War II. I mean, just totally obliterated. Lost more than, I think it was more than all the other losses in all the other countries combined. Okay, so that invasion of St. Petersburg by the Nazis, by the Germans, really hit Russia hard. And they're shell shocked still. 70, 80 years later, they are still shell shocked on that. And the idea that they need kind of a frontier, a border protection from whatever may happen in Europe and in the rest of the world, right? So Russia wants not only those ports that water access to the Black Sea, but it always kind of wants a protection, a border of countries that aren't necessarily close to the West, aren't necessarily close to NATO or the EU and things like that. That's why we saw Putin threaten some of those other countries, those other Baltic countries like Finland, and I think it threatened Sweden last couple of weeks ago. It's invading Ukraine because these countries are getting closer to the West. Geopolitically, they're talking to NATO, they're talking to the EU about a accession into the EU, and Russia wants that border with the rest of the world as some kind of a protection, right? It figures if it keeps a neutral border of countries around it, then if any country in Europe becomes more aggressive or wants to do something, obviously they got to work through those border countries before they even get to Russia, right? So that's kind of the perspective of the Russian population here, and Putin is just I think taking advantage of that to really be aggressive here and move into some of these other countries, into Ukraine. But they don't want to occupy Ukraine. Obviously, we've seen the Ukrainians have come out fighting for their country, and they're not going to give it up, and they're never going to give it up. Even if Russia was able to demilitarize Ukraine and fully occupy it, it would be a quagmire like they haven't seen for 30 or 40 years. So basically, Putin wants to go in there. He wants to occupy. He wants to, for very, very short time, just long enough to have that strength at the negotiating table to negotiate a demilitarized Ukraine, a full recognition of its stake in Crimea, as well as the idea that Ukraine will not become part of the EU or part of NATO. Okay, that's where they're coming from. So you've got to take that and think, okay, Russia does not want a long, prolonged war. Okay, it wants to get what it wants and get out quick, right? So I don't necessarily think this is going to be a long, protracted thing because of that. We're also seeing the international community come down hard on Russia. Those sanctions. A lot of companies, Visa, MasterCard, PayPal have all pulled out of services of Russia, it is starting to cause some real economic hardship. And in fact, JP Morgan now is estimating that the Russian economy will fall 12.5% this year because of those sanctions, right? So this is not something that Russia can make a protracted thing out of. They need to resolve this very quickly. They need to do it looking strong. Putin does not want to lose face. If he were to go to negotiations looking weak. So they want to look strong with this, but they do want it just as much over as everyone else does. And we are starting to see some real economic consequences of the war outside of Russia as well. Gasoline jumped to $3.83 last week in the U.S. That's the highest since 2008. Gasoline was up 41 cents a gallon just in the last month, right? So that is rising. That is probably going to continue to rise for the next week as gasoline prices catch up to that spike in oil. We're also seeing some of the agricultural commodities really boom higher. Russia and Ukraine, they are not a big part of the global economy, but where they are a big part is in that oil and in agricultural commodities like wheat and like some of these others. Obviously it's the Ukrainian farmers are finding it very difficult to plant anything, so that's taking that part of the market off the supply. Russia is very important for global wheat. And that's obviously in question as well. So, agricultural commodities have jumped higher, gasoline and oil has jumped higher, and it's really starting to change the expectations we have on inflation. Where it was possible earlier in the year that inflation would start coming down during the summer. I've been talking about this for a while. I don't think we get anywhere close to the 2 or 3% inflation that the Fed or a lot of economists think that we'll get to. But we could have gotten down to maybe a 4% inflation rate year over year, right? We still have very high wage growth. We still have very high rents, things like that. But some of those other, like the supply shock, the supply chain issues, some of those other pandemic-related inflationary measures were coming down, and it was looking like inflation was going to come down. Obviously, this has thrown a wrench into all of that, okay? With oil up to $130 a barrel, with gasoline up almost $4 a gallon, and beyond that in some places, then we're going to see that bleed through over the next couple of months into the consumer price index. We do see the CPI, that consumer price index for February, come out this week. It's really the big economic news this week to watch. That comes out on Thursday. It's expected to be another multi-decade high, highest since like 1982 at 7.8% expected. There's a better chance than anything that it's higher than expected as well, probably up to even as high as 8%. So I think that could be a real pain point for the market when it's reported on Thursday. Obviously, a lot of the oil and gasoline increase that we've seen over the last month won't even be reflected in that measure. That's going to hit in the March report next month, okay? And that's when we're really going to see inflation jump up on that energy, on those oil prices and things like that. So, inflation is looking like it's going to be higher for longer. That is obviously going to keep investors on their toes, going to keep the market under pressure for quite a while. So that we don't have any commentary by the Federal Reserve or members of the Fed this week. They are in a quiet period before the March 16th meeting. Okay, so the next meeting of the Fed, March 16th, that's the week after this one, and that is the one where they will start raising rates. They will start increasing rates. Chair Powell last week has said that he's in favor of a 0.25% move. That's probably what we're going to see, right? At one point, we were actually expecting maybe a 0.5% hike in rates, a little bit higher, just to send that message that the Fed was serious about fighting inflation. But now I think with the Ukraine conflict, the Fed is going to take a little bit more wait-and-see approach and see how that affects the economy, how that affects other related ideas, and go a little bit slower. So probably a 0.25% rate increase this next week. Again, it was one of those things that before the invasion of Ukraine, I was very positive that in March we could start seeing some kind of a relief rally in stocks, right? As investors look at, moving on from a sell the rumor kind of idea with Fed rate hikes into a buy the news idea, where there was that sense of relief that, okay, rate hikes started, it's not destroying the economy, we can still see economic growth even as rates increase, and the market would start to rebound. Obviously, with higher inflation from energy prices and the invasion, as well as lower economic growth just from the conflict, that throws that kind of into question. But I think it just pushes it back. I don't think it necessarily takes that relief rally off the table. It just pushes it back into maybe April or May. So as soon as we hear some kind of serious discussions around around negotiations and some kind of a settlement for that invasion. And I think obviously we had ceasefires over the weekend to evacuate some of the cities in Ukraine. Those were obviously didn't go as planned. Ukraine is saying that Russia is breaking those ceasefires and bombing a lot of these cities where they had those ceasefires. But eventually we'll get some kind of serious negotiations out of Russia. Again, I think it's too early for that. Russia does not want to go into those negotiations in a point of weakness, which it is right now. This is going on for way longer than Russia thought. They thought it would be like a 3-day war and get in there, occupy, get to the negotiating table, and get what it wants. It is obviously not being able to do that. So I think it's gonna have to be come from a position of strength to really bring Russia to the negotiating table for that. That said, I think you can still be very selective on picking up some of the stocks, okay? Especially some of these growth stocks we've been talking about over the last couple of weeks. These growth stocks that have come down already, 60, 70, even 80% since February of last year. All you out there in the nation know I hated those stocks last year. I talked constantly about how expensive they were, how ridiculously expensive they were last year, and just could not see myself, jumping into that trade. Now, however, I mean, you look at these companies; they're the same companies. You think companies like Teladoc, companies like SoFi, companies like some of those other really innovative companies. They are still going to change the way we live over the next 10 years. They are still the same companies, but at a 60, 70% discount to what they were last year. So I think, you can still look at some of these companies. Obviously, they can come down harder. But, over the longer term, they are still growth stocks. They are still very strong investments. You got to put it into perspective, folks. If you look at what Amazon did, Amazon went public in 1997, right? Made it up to, I think, something like $120 a share by 1999. Okay, during the peak of that dot-com bubble, Amazon up to about $120, $140 a share in 1999, came down to $5.60 a share by 2002. Okay, 2001, 2002, somewhere in there, less than $6 a share. Okay, they lost. Investors in Amazon from that peak lost 95% of their investment, lost 95% of the value in that stock. And now look at it. It was still the same company. It was still a company that was going to change the world over the next decade, over the next 2 decades. So investors that held at that $5.60 per share, they're now sitting on $3,000 a share right now. They're now sitting on a gain of it's like 300 times their money in just 20 years because they picked up those shares at that discount. For a company that was still going to change the world, still a growth company. So I think you can be selective and get into some of those stocks now. I would be conserving some cash. So maybe, if you invest your money each month, put some money into your investing account each month from your paycheck, take half of that, maybe selectively buy some of these stocks that you really like, and keep the other half in cash. Wait a couple of months for the Ukraine situation to come off, and then you can start picking up other stocks at a little bit better valuations. Some of the stocks I'm looking at watching this week, I want to cover some of those. We can go over to here. The Gap. The Gap is reported earnings release. Actually reported earnings release last week, but it just wasn't enough to pull the shares out of its recent slump. The Gap is now down, up just slightly today, but now down 20% in the last month alone. Management it was actually a fairly good earnings release for the Gap. Management guided to a positive outlook with earnings as high as $2.15 a share this year, as well as an operating margin. So profitability supposed to be higher this year at 6.8%. Both of those were well above what was previously expected of the stock. One of the big upsides for the Gap here is Athleta, the Athleta brand. It's their athletic leisure wear kind of brand. It's expected to grow to about $2 billion in sales over the next few years, which would be a big part of the valuation in the stock alone. That's going to add some tremendous growth to this. And actually, there is some talk about a potential spinoff of that brand. Okay, if the gap continues to struggle, if the stocks continue to struggle at this point, I could see an activist investor coming in, like we're seeing with actually Bed Bath and Beyond this morning. We'll talk about that. Bed Bath and Beyond up like 80-90% today on activist pressure from an activist investor. We could see that in the gap as well. I think if they don't spin off this Athleta brand, or if the stock fails to go anywhere from here, we could see somebody come in and say, hey, you need to sell off that Athleta brand, monetize that, because that is unlocked value right there. Shares were up as much as 11% on Friday in the gap, before the rest of the market just dragged it lower, right? So, I think obviously the gap, if you look at the chart here, just even over the last 5 years, the gap has always been a roller coaster ride. You can look at the max here. The gap is always up and down, pretty significantly. Management isn't great there, but they've got some great brands with the Gap, Banana Republic, Old Navy. Old Navy is like the largest consumer apparel brand in the United States. So even bad management can't keep that stock down. It was up as high as $33 just March of last year. And you see these peaks. It is always a roller coaster ride where the bad management decisions bring it down, only until the good company assets bring it up higher. So I would definitely be looking at the gap right now. It's actually in our 2022 Bowtie Nation portfolio. Added that in last week, and we're coming out with a video on that, or last week's video. Stitch Fix. Stitch Fix is expected to also report this week. Reports earnings on Tuesday. Expected to report a loss of 29 cents a share, which would be a higher per share loss than they have been doing in the past. They're expected to do $515 million in revenue, so it is still growing, and growing pretty well for an apparel company. Okay, company is just spending more on its marketing and some of the other operational costs, which is driving that loss. But the revenue growth is still strong for a retailer. And I really like the company's technology here. The company has that consumer AI algorithm, right? Where if you visit the website, Stitch Fix, if you visit that, you start spending, you start shopping, then that algorithm, that artificial intelligence algorithm that it has there, it improves your customer experience every time you visit. Every time you go back to the site, it uses its experience from what you've done in the past and improves the experience there. I really like that. I think obviously it's going to drive revenue, it's going to drive earnings in the future, and I think it makes it a potential takeover target. A lot of these apparel companies, they need that strong e-commerce internet exposure. They're not able to get it from from their brands alone, or from their legacy websites. So I think it would be very easy to buy something like a Stitch Fix, use that in conjunction with their brand and this AI algorithm. I recommended the shares in August of 2020 at $22 a share, just before they jumped to $95 over the next 5 months. Okay, so in early 2021, these shares were up to $95. After recommending it the year before. It's obviously now collapsed down below that, down to $11 a share. So I think this is where you really start looking at Stitch Fix once again on even that longer term, but even maybe on a near term bounce as well. Crowdstrike, a cybersecurity company, down 30%, which is really surprising. Crowdstrike cybersecurity down 30% from its October peak, even as that cybersecurity theme is really coming back to the forefront, on the potential of it being kind of a new front in the Ukraine conflict, okay? Obviously on both sides. So cybersecurity only growing in importance, and yet some of these companies, these cybersecurity companies, are coming down in valuation. Company is expected to report earnings of 20 cents a share on $410 million this week, when it reports. Both of those are up 50%. So we're seeing 50% earnings and sales growth on CrowdStrike. Even after the drop, though, the shares are still trading at 27 times this year's expected sales. So again, it's very hard. It's hard to get excited about any stock trading for 20 or 30 times sales. What we've seen, especially this quarter over the last few weeks, is these companies that are trading so expensively, so rich valuations, they're having great earnings quarters. They're maybe talking slightly pessimistic about the outlook for 2022, and it's just destroying the shares because they are so expensive. So I think I would watch CrowdStrike. I don't think I would buy into it right here, especially since it is still 27 times expected sales. But I would look at it to see if it comes down on its earnings this week. DocuSign is also expected to report earnings this week. On Thursday, expected to report earnings of 63 cents a share on over $700 million in revenue, which is really interesting because I mean DocuSign has come down. Obviously, it's down 68% from last year's peak because investors just continue to see it as only a COVID growth stock, right? Investors are selling off everything COVID growth, right? The Zoom, Teladoc, all those stocks down 50, 60, 70% over the last year. And DocuSign, I think, is much more than that. I think DocuSign is much more into that work from home trend that we've seen develop over the last decade, really, but really accelerate over the last couple of years, and is here to stay. Okay, I use DocuSign all the time, in my work, signing contracts, things like that, so I can sign things digitally instead of having to print off copies and fax or email those back. And what we see here is a quality growth stock. They're reporting earnings of 63 cents a share, positive earnings versus a lot of these other growth stocks that we're also trading at very high valuations and with no earnings. Okay, shares trade for 11.4 times sales, which is higher than I usually like seeing. On a growth, even on a growth stock. But I did pick up shares just recently in DocuSign. Another one I'm watching is AT&T. It's got its investor day on Friday. Okay, so already released earnings for the quarter, but it's got its investor day Friday. It's going to update us on the spinning off Warner Media to Discovery, and then the company's strategy going forward. All you out there in the nation know I've been skeptical of AT&T in the past. I posted a warning to investors in 2018 that management strategy was just unsustainable, that dividend was unsustainable. We're really starting to see this come back to them, to hit them. They sold off their direct TV, the satellite business. They're spinning off Warner Media, the Time Warner acquisition that they made, to Discovery. And I think that strategy puts them in a better direction, right? I still don't like management. I still think management needs to change, but obviously this is the right direction. They're going to be able to focus on telecom and telecom only. They are going to have to cut the dividend. Obviously, they've already made that announcement. Dividend is going to be cut to about $1.11 a share, I think the announcement was, which is actually still about between 4.5% and 5% dividend yield, which is still one of the highest in the S&P 500, one of the highest dividend yields you'll find in these old school telecom names. So I like the stock. I bought about 30,000 shares of AT&T back a couple months ago when it was at $23 a share. It went up quite a bit, but came back down to that point now. I think this is one that you can look at it. It's not going to make you rich, but it is going to be solid, stable cash flow, and it could be a $30 stock, right? So besides that 4.5% dividend, you're also going to get the the upside appreciation on the shares. Big news stock today: Bed Bath & Beyond. Bed Bath & Beyond up 85% today to $30 a share on news that the chairman of GameStop, Ryan Cohen, has actually bought a big stake in GameStop. Made him the fifth largest investor in the company, or bought up a big stock in Bed Bath & Beyond, ticker BBBY. Makes him the fifth largest investor in the company, and he's really going to be putting pressure on the company to either spin off its Bye Bye Baby division, which is really strong, a really strong store there, or sell off the whole company, or make some kind of strategic news to really unlock the value in this stock. Now that said, I do think the value is now in this stock. It is built in there with that 85% increase today. This was one of those meme stocks. So it's not to say that it couldn't jump higher if a lot of the meme stock frenzy comes back into it. It was up $35 a share, $35 a share January of last year when that meme stock frenzy was in there. So I don't see it running. It could run back up to $35 a share. I don't really see it that much higher. I've actually got shares. I bought shares in at about $15.60 a share. Sold call options at the $20 strike against those. So that's where my position lays in that. If it does come back down to under $20, I would buy more back in at $20, especially with that activist investor pressure. I'd probably buy back in and then sell those calls, those covered calls on that position as well. Here though, at $30 a share, I don't think you jump into this just because I think the value is already back in there. I want to talk about a few things in cryptocurrency here because we are starting to see some movement in cryptocurrency. One thing I did notice over the last week, another billionaire skeptic of cryptocurrency actually came out and admitted he was wrong. So billionaire Ken Griffin, founder of the Citadel Securities hedge fund, has actually come out and said they will start investing in cryptocurrency. He's been one of the most vocal critics actually of Bitcoin. Yeah, at one point he said Bitcoin was a jihadist call. He said it is a jihadist call that we don't believe in the dollar, right? So a very, very vocal critic of Bitcoin and of cryptocurrencies. Actually talking to on Bloomberg Wealth with David Rubenstein last week, admitting he was wrong, saying it's been one of the greatest stories in finance over the course of the last 15 years. So imagine that, going from saying that Bitcoin is a jihadist call against the dollar to saying, hey, it's one of the greatest stories in finance over the last 15 years. He does admit he's been wrong. He says, I've been a naysayer in the camp for over that period, and which tells you that I haven't been right on this call. So I think what you see in a lot of these skeptics of Bitcoin, of cryptocurrency, you had Warren Buffett that has called Bitcoin rat poison squared in the past. He invested $1 billion just over the last couple of months in a crypto services bank called Nubank. Okay, you see a lot of these, J.P. Morgan CEO Jamie Dimon has been also a very vocal critic of Bitcoin, of cryptocurrencies. J.P. Morgan is offering their clients, their customers, cryptocurrency holdings and investments and services. So you really got to look at how that environment, how that perspective on cryptocurrency, on how Bitcoin is changing, and and keep that in perspective. Another thing I want to talk about here is in relation to Bitcoin is the sanctions against Russia. The idea that maybe we don't have full security in foreign exchange reserves, things like that. What you saw here over the last couple of weeks and why Bitcoin really rose, in light of the invasion of Ukraine and things like that, is that a lot of the central banks around the world. So if you don't know, so the central banks of each country, they hold foreign exchange reserves. Okay, they own part of their money reserves in other countries, just to kind of protect their money or protect themselves against a fall in their own currency, right? It's kind of an insurance policy against inflation and depreciation in their own currency and the need to pay bills in other currencies, right? And of course, a lot of that foreign exchange currency is held in dollars, it's held in euros, it's held in yen, and it's all held in other banks, in other central banks around the world, right? That's what makes it. It's the foreign reserves. Well, what happened when Russia invaded Ukraine is a lot of those central banks around the world, they stopped payment. They're holding those $630 billion that Russia has set as a reserve outside the country. Okay, so they're really holding that hostage against the aggression against Ukraine. And so what we're seeing is really that reimagining, that revaluation of what money is. If central banks can just cut off your foreign reserves held on those geopolitical events, then is holding a dollar really really the reserve currency? Is holding a dollar really as safe as you might think it is? Okay, and so that's why I think we've seen a lot of people, a lot of the Russian population, a lot of Ukrainians, besides those super high inflation rates, besides the collapse in their own currencies. It's really why we've seen a lot of interest in Bitcoin, on that. One thing, so I think that's where you see a lot of the Bitcoin strength, a lot of the cryptocurrency strength over the last couple of weeks. One thing I do want to talk about is the idea that Russia is going to be able to avoid sanctions using Bitcoin, using cryptocurrencies. a lot of false information out there, even from some people that should know better. Okay, a lot of senators, Senator Warren in the U.S., a lot of senators, a lot of people, that should know better, are saying that Russia is going to be able to avoid sanctions, get around those by using Bitcoin, and it's just not right. Okay, these people, they should know better. They've got advisors, they've got people talking to them that know differently. They're just trying to spread false information. And what I want to show you here is why that's so. So we can go to the coin market cap. Okay, we can go to this coin market cap. It's a website that shows the trading in all the cryptocurrencies, the daily volume, things like that. And what I want you to look at here is, in this idea, is this Bitcoin right here is the market cap of $740 billion, right? With volume, 24-hour volume in Bitcoin is only $24 billion. Okay, $25 billion of Bitcoin is traded every day, and the actual Bitcoin circuit, the Bitcoin transactions each day is around 300 to 400,000. Okay, so there is not that much trading going on in Bitcoin on a daily basis. 300 to 400,000 transactions a day, about $25 billion. So what you need to understand here, when people talk about, oh, Russia, the government or the banks or whoever is just going to be able to move all their money back and forth in Bitcoin instead of across the SWIFT program or the SWIFT system in the banks and things like that, it's just not possible. There is just not the scale or the liquidity in Bitcoin. So we talked about $630 billion in foreign exchange reserves being shut off from Russia. Okay, we talked about there's the banks of Russia need to move billions of dollars a day, tens of billions of dollars, in their daily business. To avoid those sanctions, they would have to move billions of dollars and tens of billions of dollars in Bitcoin, and that's just not possible. Okay, you would immediately see if the 24-hour volume of Bitcoin traded was only 25 billion, if even that increased 2 or 3, 10%, $2 or $3 billion because Russia or the government or the banks were trying to avoid these sanctions, it would be immediately clear. And what you got to understand is Bitcoin and cryptocurrency is not quite as anonymous as you think it is. Okay, each transaction of Bitcoin is a permanent mark on the ledger, on the blockchain ledger. Okay, that never goes away. You can go back, you can see what every transaction in Bitcoin was back all the way back to when it was created. Okay, so if any of those, we've got 400,000 transactions a day. Very easy to find any particular transaction. If it's a big transaction, something moves the market by $1 billion. The governments, the U.S. government, a lot of these sanctioning governments, they're going to immediately be able to see what transaction it was, what account it was. They're going to be able to track that account's transactions back into the past and see, okay, is this a Russian government account? Is it an account from one of the Russian banks? They are going to be able to sanction that account. Okay, so even though a lot of the Bitcoin and cryptocurrency exchanges have said, no, we're not going to cut off all of Russia from cryptocurrency because it's something that the Russian people need just as well as anyone else to protect their money from depreciation in their own currency, from the collapse in the ruble. We're not going to cut everyone off, but they are watching the accounts for those sanctioned entities. Okay, so it would be immediately clear if any of these entities, the banks, the government, even some of the larger oligarchs, if it would be immediately clear if they were trying to avoid sanctions through cryptocurrencies, and they would be able to trace that back. So not necessarily a lot of the false information and the things that you see there. One more thing I want to look at. Had some big news in Amazon over the last week. Activist investor Daniel Loeb sees roughly $1 trillion in untapped value in Amazon. That would move the market cap up to about $2.5 trillion. Be about a 66% increase in the price of Amazon right now. And basically, what he's saying, he was talking to a private group of investors in his hedge fund just a few weeks ago, talking a private call with investors. Said that his analysis, he showed some slides there, showed that the AWS, the web services or the cloud segment of Amazon is worth $1.5 trillion alone. So that's pretty much the full market cap of the stock right now. Stock's trading at right around $1.6 trillion. He's saying that Amazon Web Services is that alone, and then the e-commerce business, the retail business, is worth another $1 trillion. So he's a big investor in Amazon shares. Obviously, not really putting the activist pressure on Amazon to really do something to unlock that value just yet, but he is there and he is vocal about what he wants with the company, right? So I think what you see here is eventually, Amazon talking about splitting off the company, splitting off that AWS, that web services cloud segment from the main e-commerce segment. Okay, and what that would do is not only unlock that value. Okay, so you would get shares of the $1.5 trillion Amazon Web Services company and the $1 trillion Amazon e-commerce company. $2.5 trillion total. That would be about a 66% increase in what you own right now with Amazon shares. So you would get shares in both of those companies. And I think that would release a lot of the pressure from regulators, from the government about kind of monopoly control on the company. Okay, so if it did break up, not have that kind of scale and that kind of scope, it would bring off some of the pressure that you're seeing from regulators on Amazon, at least. So definitely news to watch for Amazon and something you want to know there. Now I want to before we open it up to comments, I want to talk about come back to what we know and how to invest on this whole conflict, on the invasion of Ukraine. Again, Russia does not want the Ukraine. Okay, they want it demilitarized. They want assurances that it won't be ceded into the EU or into NATO. So I think that just says that it should be a short conflict, and we should really kind of invest around that. And what does that mean now? So you got to look at things like interest rates. Oil, okay, a lot of people, oil up to $130 a barrel overnight. A lot of people getting into oil at these prices, into oil stocks, and I think it's real dangerous, right? Because even with inflation pushing oil prices up, with a lot of that, so oil should be right around $80-85 a barrel. That's about where it was before the invasion. If we get any kind of negotiated settlement or a serious idea of negotiations, then that price of oil is going to come down. Okay, so I think at this point, if you do own oil stocks, if you own some of those, hold those, maybe sell some covered calls or some protection against those. Oil could go higher. There's talk of oil at $150 a barrel, and that's possible. But I think the bigger risk here is to this conflict, to this invasion being short-lived, being going to some kind of negotiated settlement. That is the risk. So I don't want you jumping into the trade that's already been traded. Okay, a lot of people already in the oil trade, pushing those prices higher, and it could move on a heartbeat. Okay, so I think oil prices do come down, back down to $80-90 a barrel if once we get any of that news, and that could be any time over the next couple of months. Interest rates are down to 1.7%. The biggest news there is probably if you haven't refinanced. If you're going to refinance your house, do it now. If you're trying to get a loan, do it now. Okay, because those interest rates, they were up above 2% before this whole thing started, and they're going back up there. After this is resolved as well. So interest rates are going to go higher. That's going to affect a lot of the stocks. Okay, so interest rate sensitive stocks like utilities, like real estate, consumer staples, a lot of those stocks that benefit with lower interest rates because they pay off those dividends, those are going to be under pressure as interest rates go back higher. Okay, you look at financials though. Financials benefit when interest rates go higher. Okay, so if you're looking for a trade, then I think the financials are very attractive valuations here. Those bank stocks, I think you can get in those. Wait until the interest rates start going higher after this is resolved, and have some good returns there. The consumer spending is still strong. That's one of the big things that is really supportive of this market. Consumer spending, even in Europe, but more so in the U.S., consumer spending is still strong. Oil prices and gasoline is starting to hit. So if this goes any longer than maybe a month or two, then it's going to bring down those expectations. But the consumer is still strong enough. Businesses are still strong enough that if we can get some kind of a settlement over the next couple of months on this, I don't think it's going to materially affect the economy or that growth. So I think that makes stocks very attractively valued right now. I want to open it up to Q&A here. Take some questions. I see a lot of questions there in the in the chat. I'm going to scroll back up here and see what we've got and answer those. Intermediate handyman, $5. Thanks for that. Thank you for that super chat. I appreciate it. It says your sales spreadsheet is no longer loading stock data. I'll have to check into that. Go ahead and send me an email through the. You should have through Teachable. You should have the email to be able to send comments or things like that. And I'll look into why is that not loading stock information. Any thoughts on this and the future of Workhorse? Future of Workhorse. Workhorse is tough. Workhorse, they've actually stopped production on their main electric vehicle van and are really kind of moving into other things. What I think I'm looking at in Workhorse though is that even on that bad news, even on the announcement of stopping production on that van, really focusing on some of the other models they have, the stock still jumped, okay, and it's found a real level of support here, right around, I think it was right around $3.50 a share over the last week. So I think it's found some real support at that point. If you're a very risk-on investor, if you can handle the risk, maybe you can start investing in shares. I do like other stocks better though. Workhorse, it's just so uncertain that I don't know that the risk reward is right there. Okay, basically Workhorse is a lottery ticket right now. Okay, you don't know if it's going to be the next big thing in electric vans or if it's going to be completely bankrupted over the next couple of years. Okay, so that is very much a lottery ticket. I think if you're looking for that higher return, I think there is many more stocks that you can go with instead of Workhorse. I think things like Teladoc, things like SoFi, things like even PayPal. A lot of these growth stocks that have come down 60 and 70% do not have that existential risk of Workhorse. Okay, these are going to be companies. These are still going to be companies, going concern companies. They're still going to grow. And they're still going to change the way we live. Okay, they're in no danger of going bankrupt or anything like that. Which Workhorse, there is a real danger of it going bankrupt over the next couple of years. There is the opportunity there to double or triple your money or even more. But like I said, it's a lottery ticket. So you got to understand where your own risk return idea is on that. What else? I can show this one. State of the hospitals would cease in a moment. Okay, tell me what. Going through again, if you have a question, please use a question mark so I know that it is a question. Dear Inferior, looking like 70s when Carter was president. There's a real talk of stagflation again in the markets just because inflation again. The inflation numbers next month and the month after that, I think, are going to be very surprisingly bad. We saw gas prices up 40 cents in the last month per gallon. Oil up 25% just in the last week. That won't be in the CPI and the Consumer Price Index inflation numbers that we get here on Thursday. That won't be in those, even though those are expected to be very bad as well. But that's going to hit next month in those numbers. And so I think the market is going to have to readjust to those higher inflation expectations now. And again, for the next month or two, it's probably going to be a very weak market unless we can get some kind of negotiated settlement from from the Russian invasion. So what else? Everything else. Why isn't AT&T stock dropping? Everything else is. DL wants to know why isn't AT&T stock dropping? Because it's dropped for the last 2 years, 3 years, right? You've got a lot of stocks that were already dropping so much and have now found that level of support. It can only get so bad until the stock price kind of levels off, even in the worst news. With AT&T, I think you're starting to see AT&T as a real safety stock at this point. Okay, in the past couple of years, it wasn't necessarily that safety stock telecom kind of idea as it has been, in the past before that, because they had DirecTV, because they had Time Warner, right? It was much more of a communication services stock rather than telecom. Okay, but now that they've sold off DirecTV, now that they're spinning off Warner to Discovery, now it's going to be focused on that telecom. It's going to have much more reliable constant cash flows from that telecom segment. So I do think you're going to start seeing AT&T be more of that safety stock, okay? The stock that people run to when everything else sells off, when the market crashes, when the market sells off. So, I think that's why you're seeing AT&T kind of level off here and not quite see the drops that you've seen in the past. It is, even after that dividend cut, it's still going to provide a 4.5% dividend yield, which is extremely good, extremely high. And you've got the upside potential in the stock, I think. Why are materials down? Would materials correlate with industry movements? Okay, so very good question. Why are the material stocks down? And let's look into that, because that is a good question. Why would materials be up if a lot of the metals prices are higher? And what you got to look at when you look at by sectors. Okay, so like I said, I love to start with the sectorspider.com, the sector tracker, just to see that big picture of where the stock sectors are going. But then you got to understand, once you do see that picture, you also got to keep in mind that there's different industries within each sector. So what you see, okay, so if materials is down 1.5% last week, even despite a lot of these, a lot of the miners, the commodities going up, then you still see, what did we see? So we saw within the materials sector, the fertilizer companies obviously did very well. Okay, fertilizer with the increase in agricultural prices, fertilizer stocks did very well. The gold stocks, a lot of those miners did very well. What was on the other end though? So chemicals, and what we sell with materials, and really the big hit, especially here with this Linde PLC, down 5.5%. That is 15% of the materials sector. So what you saw really over the last couple of weeks, is that the chemicals companies, because of the idea that the Ukraine invasion may slow global growth, then there might not necessarily be the demand for these chemicals, for these industrial chemicals. Okay, so that has brought a lot of these companies down. They're also suffering from inflation. A lot of these companies, I know PP&G talked about it in their earnings, but a lot of these companies talking about how inflation is really eating into their profitability, not only their cost of goods, but also the wages that they're having to pay. So you're starting to see real effects on inflation, as well as just lower demand for industrial products like chemicals in these companies. Albemarle down 6.7% last week. It's down quite a bit, over the past couple of months. A video I've got coming out on Wednesday, actually, talking about the lithium stocks. Really interesting here. These lithium stocks have sold off. Lithium miners, a lot of lithium companies have sold off 20 and 30% from their peaks from last year. Really moving, following Tesla, shares of Tesla down lower. But the thing is, the supply demand picture for lithium is only going to getting better. Okay, we're looking at something like a 10 or a 20 times increase in the demand for lithium over the next 10 years. Okay, because of electric vehicles, not only the amount of electric vehicle production, not only the number of cars and trucks produced, but the size of the batteries needed. Okay, when we start really getting these electric vehicle trucks and even semi-trucks and construction equipment moving on electric, you're going to see that the size and need of those batteries grow exponentially. So it's really interesting that some of these lithium stocks like Albemarle, that's ticker ALB, have really come down off of their highs, even though the future is pretty bright for a lot of those stocks. So what else do we have in the comments? Going to switch it here. So DL talks about one thing we've seen about the whole sanctions idea with Russia. They really don't even need Bitcoin or cryptocurrencies to avoid those sanctions. A lot of those banks are now running to a Chinese banking system, as an alternative to SWIFT, to the SWIFT system, to really be able to avoid some of those sanctions and be able to conduct their business as normal. So again, Russia, the government, the banks, they don't need Bitcoin to avoid those sanctions. They've got other ways to do it, and really don't want to do it with Bitcoin, because that transaction is traceable and it is forever. So the other organizations, the governments and the sanctioning bodies would be able to immediately see if they tried to avoid those sanctions through Bitcoin, through some of these other cryptocurrencies. What else do we have? So just trying to read through the comments, trying to look for questions here. That's when people are getting scared. So Danielle wants to know, wouldn't spending go down since people are getting scared? I don't know that they necessarily are. So if we're looking at maybe in Europe, but not so much there, but in the U.S. Consumer spending. If you look at consumer spending surveys, if you look at just people's actions, people are fed up with being shut down in their house after 2 years. They want to get out. They want to spend that money, and it just doesn't appear that the invasion of Ukraine is really affecting that consumer spending behavior. So I don't necessarily think that would be the thing that causes consumer spending to fall. Now, obviously, the big thing with consumer spending is going to be those gasoline prices. It's going to be the energy costs. Okay, so that is the real worry, that if this keeps on going and those gasoline prices stay higher, that is going to weigh on consumer sentiment and consumer spending. But it's not necessarily that. I don't think they get scared over what's happening, the geopolitical events in themselves. So I still think that really tells you that, okay, if this is a short negotiated settlement kind of thing, then you can start to look at some of those consumer discretionary stocks, the stocks that have hit really hard but still have that consumer spending force behind them for the rest of the year. You can start looking at some of the financial companies that are going to benefit as interest rates go back higher. Okay, what else? I need some room. Oh, okay. So Carlos wants to know if the desk microphone is on. I'll have to check that out. It might have been. Hopefully this is working, but let me know if I'm coming through all clear there. Need to adjust the mic. Yep, I'll have to check that out and adjust it for next week, I guess. What sectors did you recommend during this time? So again, Kludge wants to know what sectors I'm looking at, and again, we talked about that earlier in the broadcast. A lot of sectors, really good valuation territory. Materials down 15% from its 5-year average PE ratio. Financials looking really attractive after coming down quite a bit over the last couple of weeks. So financials, materials. A lot of those that have been hit hard, as well as the growth stocks. Like I said, be very selective, but I am picking up some of those growth stocks that are down 40, 50, 60% over the last year, because they are still growth companies, even if the stocks have come down and really burned a lot of people. So you got to be dispassionate about your investments. You can't get so emotional about a stock after it comes down and loses a lot of money that you just give up on it. Because these are still good companies. These are still very strong, growing companies. Going to be very good companies over the next 10 years, and one of them will be the next Amazon. Okay, one of them will be the next stock that produces that 300 times return over the next 20 years, and you definitely want to be in that. What else? What else? Thoughts on Palantir. Specialist Perspective wants to know about Palantir. Actually, just did a video, last week, I think it was, maybe the week before that, on Palantir. Look for that in the video section on the channel. I picked up shares of Palantir, just after Cathie Wood and ARK Invest started selling it. Okay, it always seems to be kind of the trigger, I think. When you start seeing Cathie Wood and ARK Invest selling a stock, that's usually when it bounces higher. Okay, we saw it in Virgin Galactic. We saw it in Snap. They sold out a Snap over a period of weeks, and then the stock was up 50% on the day of its earnings. Okay, the same thing with Virgin Galactic. They sold out, and then it was up like 30% in a few weeks after that. So it's I think it's a real sign of capitulation, what we say when ARK Invest sells out of the stocks, because supposedly they are all in these innovative growth themes for decades. They think they're saying that these stocks like Zoom, like Palantir, like Virgin Galactic and whatnot, and all these, they're saying these are going to change the way we live in the next 10 or 20 years, and yet they're selling them just because they go down in any given year. Okay, but just because they've gone down over the last year, they're selling out of these stocks. Well, I think that's selling into weakness, which is something you never want to do. And when you get that signal that even the most perseverant investors are like ARK Invest, even the most vocal investors in these stocks are just giving up and running for the hills, that's when you start picking up shares, because I think that's when that level of max fear is in those shares, and you've got that real floor of support under the shares there. So it's not to say that Palantir isn't going to follow a little bit more, especially it's going to follow the market to some extent. These growth stocks, they're very sensitive to how the rest of the market and investor sentiment is going. So understand that for as long as the market falls, these growth stocks are probably going to fall further, okay? Even though there's good, strong companies, even though there's strong, good valuations right now, they're still going to follow the market down a little bit lower as investors get more negative on stocks in general. But there is that floor of support. They're not going to crash anymore, down 10, 20% again. So you do have that floor of support, and I think you start picking up shares here in that level of max fear for the next 10 or 20 years. Okay, it sounds a little racist with jihadist comment from that. Yeah, Trashly wants to. That's a low-key racist for the jihadist comment from the billionaire Ken Griffin. Yeah, I mean, I think he said that at a time when it was fashionable to kind of pin. It's fashionable sometimes to really make those relationships, where it's just completely out of line. But people like to do it. Okay, how about investing in Brazil assets? What do you? So Alex Lima wants to know about investing in Brazilian assets, investing in foreign markets. I mean, I've in the past I've been a big believer in emerging market investing. Brazil, India, even Russia and China. In the past, I used to do an emerging market newsletter back in 2012 for a website, and I've really, over the past 10 years, I've really come to the realization that these emerging markets, especially the ones like Brazil, the ones in Latin America, the ones in Africa, these emerging markets are never going to emerge. Okay, there is a real structural problem with their, with how their government is run, how the trust in institutions, how their institutions are run, the corruption in their systems, that is going to keep them from ever becoming anything like a developed market. Okay, the idea that these emerging markets are going to emerge and catch up to these developed markets, and that's going to be higher returns. It just doesn't happen. Okay, we've been talking about that for the past 20, 30 years, and it's never happened. Okay, and it likely will never happen. Okay, you see a lot of these stocks in Brazil, in these other countries, Latin American countries, they seem like terrific valuations. They're very, very low on a price to earnings basis versus U.S. versus European stocks, but they just never seem to catch up, and it is because of those real structural problems in the government, in their institutions, and really in just the trust in those institutions with the population. The population doesn't trust institutions. That leads to corruption. That leads to cheating on a lot of the institutions and a lot of the things. And so I just don't do it. I get a lot of my foreign investments from just regular S&P companies that have businesses in those countries. I do own some market funds, so developed market funds that invest in stocks of other countries, just kind of that broad exposure, but it's a very small part of the portfolio. I do not, I don't invest very much in that. Okay, what else? What else? Trend Board says Coinbase stock is underperforming. Well, Coinbase stock is just gonna follow. It's going to follow Bitcoin and cryptocurrencies, okay? Because that is all Coinbase is right now. Coinbase is exclusively a call on the revenue it generates from trading fees on cryptocurrencies, which obviously cryptocurrencies at kind of a low point right now. So Coinbase, that's where Coinbase stock is going to be. Two things about Coinbase. One is I did a video a few months ago. Look for that in the video section. Where so I talked about it was just after an IPO, just after it issued shares, and I said, I would avoid Coinbase shares. That was 20% ago. It was up. It's come down 20 or 30% from then, and the reason is, Coinbase needs cryptocurrency to do well for Coinbase stock to do well. Okay, cryptocurrency doesn't necessarily need Coinbase to do well. Okay, you've got thousands of exchange platforms for cryptocurrency. Any one of them can do very well, but they all need cryptocurrency to do well for those stocks and those companies to do well. Okay, so why not invest in cryptocurrency directly? That's where you're more your win-win situation is going to be. Okay, if cryptocurrency does well and you own Bitcoin, you're going to do very well. If if cryptocurrency does not do well and you're in either of these, if you're in Coinbase or you're in cryptocurrency itself, you're going to lose money. But if cryptocurrency does well and you own Bitcoin, you're going to do well. If cryptocurrency does well and you're in Coinbase shares, not necessarily. You might not necessarily do well because you've got all these other platforms, these Binance, BlockFi, all these other cryptocurrency exchange platforms competing against Coinbase, all trying to take that market share. So just because Bitcoin goes up doesn't necessarily mean Coinbase stock is going to go up. It will probably because they're still going to get higher revenue, but it's not that win-win situation that you've got with cryptocurrency. The other thing with Coinbase is they will eventually start rolling out other programs, and that's really what they need to do. Okay, because they cannot be dependent on cryptocurrency trading fees forever. Those trading fees are going to come down, just like they did in stock investing. They're going to start coming down, and any company that is exclusively dependent on cryptocurrency trading fees is going to be crushed. Okay, so Coinbase needs those NFTs. It needs those other digital assets that it can sell and make money on the transactions. It needs those. That's when maybe you start looking at Coinbase stock, is when they start rolling out some of those other products that is going to increase the revenue and take the dependence away from those trading fees. So that's kind of what I think about Coinbase. With everything. What else? Does Chevron still have room to run? Riam wants to know about Chevron. I like Chevron. I own shares of Chevron. I actually covered my position with calls, so I sold call options against Chevron over the past couple of weeks, just because I've been in Chevron for the last couple of years now. It's a great company. It's one of the best oil producers out there, one of the best oil stocks you can own. But at oil at $130 a barrel, you're starting to see some real pressure from governments to try to lower the prices, releases from strategic reserves, things like that. If we get any kind of negotiated settlement on the Ukraine conflict, then I think oil comes down hard, and that's going to bring a lot of these oil stocks back down. So yes, oil can go higher. Chevron can continue to go higher on that, but I think you've got the real risk of it coming down in the short term. If you don't own shares now, I don't think I would get in at this point. I would wait for the oil price of oil to come back down a little bit, bring those shares back down, and then I would get in. It's a great company, very strong cash flow, great dividends, and I think the dividends are going to continue on that, but a little expensive at this point. Okay, we're about an hour and 20 minutes into this. I'm going to cut it off for this week. If I didn't get to your question, I'm sorry. Please ask it in the comments below. Be sure to sign up to that webinar on Interactive Brokers. You don't need an account or anything. Click through the link I've left in the chat there or in the description below and sign up for that webinar. It's today. It's totally free. It's going to show you how to use those put options to protect your portfolio. So make sure you sign up for that, and I will catch you in the next video.